Good morning, everybody, and welcome to this specialist lending webinar. Today is the third episode of this series of webinars. You've got myself, Dan Morris, Key Account Director at Crystal Specialist Finance. We've got John McCaffery, who is a fantastic tax advisor from Alexander & Co. And then we've also got the one and only Roger Morris from One Savings Bank. So first and foremost, for those of you that are returning, thank you very much. And obviously you've enjoyed it and you found these sessions useful, as we have, to be honest. And for those of you that are joining for the first time, thank you very much. And again, hopefully you find it useful. Before we do some introductions in terms of what's on today's agenda, anything really, to be honest, in terms of the topic. So previously we were discussing the stamp duty deadline, which we will touch on again for a couple of seconds in this one, but today is Crystal's Complex Cases Clinic. That's a mouthful. So we want to hear from you. We want to hear what you want to know, what complex questions you have from us, from a broker point of view, a lender point of view, or a tax point of view. Honestly, any question goes. As much as we've had quite a few questions come in prior to the session, which we've already got ready to be answered as such, it's anything you want to hear about from ourselves, whether it's around tax relief, incorporation relief, stamp duty, whatever that is, whether it's about adverse credit, bridging, literally anything goes. There's no script, there's no agenda. We'll just freestyle for the next hour. So without further ado, we'll do a few introductions. So first and foremost, this guy doesn't need introducing, as a lot of you will know him. Roger Morris, Group Distribution Director from One Savings Bank. Good morning, and Dad.
Morning, Dan. Morning, John. And good morning, ladies and gentlemen. Today, I think is a great format. I do many webinars where we really don't have time to kind of stop and pause. We have had, Dan and I have had a number of questions sent in from some of the delegates who want me to cover off certain areas. But also having John here, I think it's quite incredible because Dan's got a significant amount of experience in certain areas that I certainly haven't, and I've got my areas, and then we've got John as well. So we can actually get quite a round-up view when it comes to whether or not you've got questions on HMOs or Article 4s, limited companies or limited company SPVs. We're seeing an awful lot of people taking advantage of the stamp duty holiday, and after receiving good tax advice and moving the properties into a limited company. But it's about understanding the pros and cons of doing that. We can get John to give those answers obviously today. But some of the things that Dan and I often spend our time talking about: chain break finance and refurb buy-to-let and short-term lending and bridging. And then there's just the standard customers who are self-employed. So if you're dealing with the self-employed customers where it's got 1 year's counts or 1 year's in a projection, Dan, that's coming up quite a lot, you know, who will actually work off a projection. So we're going to look into how you can actually potentially work off a projection and what lenders will look at that as well. So I think we've got quite a lot I think we can cover off today, and I'm sure John might give his views also on the budget and sort of things to think out for, particularly with that potential raise to CGT. So John, I'll leave you to introduce yourself and maybe give us a few updates as well.
No worries, thank you, Roger. Yeah, the budget, despite the fact he spoke for an hour, was spectacularly dull. Basically, what we've got is everybody's rates are frozen till 2026, apart from a small increase next year. There is a corporation tax increase where your profits are bigger than £50,000. And there's an extension to the stamp duty holiday, which is a full extension till 30th of June and half the amount till the end of September, which I'm sure you're all aware of. What is coming up is something that is being imaginatively titled by the civil service, is something called Tax Day. And on the 23rd of March this month, the government is going to release a load of consultations and policy papers regarding tax for the next Parliament. Capital gains is expected to be mentioned. Again, I'm not sure whether capital gains is going to go up. I know that the rumour about capital gains going up in the budget drove transactions, which drove disposals, which drove tax income. I think that's a large element to it. And again, it may or may not go up, but I think if he's keeping quiet about when this may happen, every time there's an announcement by the government, this is going to drive transactions, which is going to drive the capital gains take. In terms of wider situations, well, since George Osborne decided to have his raid on landlords in 2016, the landscape for landlords has changed quite a bit, and there's been an awful lot of really bad tax advice out there. I've kind of got into property because of the lack of quality and tax advice that is being given to some people. Everybody's situation is different, therefore the rules apply differently to every situation, and not everybody should incorporate, not everybody should keep the properties actually. Not everybody should do the same sort of inheritance tax planning. You very much need to tailor the rules to your situation. And as I say, it's bad tax advice by taking kind of standard approaches to, well, you put your properties into a partnership and then you incorporate, and that just doesn't work for some people. So now I'm happy to have a chat around that, some cases, any questions people have on that.
Yeah,
Perfect, brilliant.
Dan, can we just mention as well, just everybody knows John's expertise is just confined to England. So that's John's area of expertise. We've just been asked to remind it. Jan, we've had a question coming, I think, from Amit. Do you want to read it out?
Yeah. Do we have any lender for a BISF HMO? Need a 75% lend. Property is 1924 made. Property is without masonry leaf.
Wow, that's a really good one. Now, even I don't know what a BISF HMO actually. I mean, I'd like to think one of my real areas of expertise is HMO, but a BISF, there's some form of acronym that I'm not sure about. If you wouldn't mind just quantifying what the acronym of BISF, let me move further into the construction. When it comes to masonry leaf, which again is quite an unusual one, what we do is if you could get us the full details. So within the USB group, we have our own internal real estate team. And what we will do, and we work with Crystal on this, if we get properties of unusual construction, all right, the British Iron and Steel Foundation pre-Second World War made properties. Do you know what? I recently did a full hour session with Knowledge Bank on construction, anything from Mundic block to Wimpy No Fines, and it's the first time I've actually had that abbreviation. Now I actually see it, then we're fine. With a lot of situations when it comes to these type of properties, and obviously it's been up for around 100 years, is what we would do is we would take that specific property, that property address, we'd see whether or not there's been a full structural survey done on it recently. And what we'll do is we'll get commentary back from our real estate team through Crystal and be able to give you a decision on that. The fact is the HMO is fine. When it comes to HMOs, first things we look for is where that property is located. So if that property is located in a standard area in the United Kingdom, let's take England and Northern Ireland first, we look to see whether or not there's an Article 4 in place. Now, if there's an Article 4 in place, if that property would then need to have had planning for change of use from a C3 to a C4, and if planning hasn't been passed, then we'd need to actually verify whether or not planning would be granted. So we often get applications where a license is in place, might have been in place for 2 or 3 years, but the applicants never applied for the planning application, and the two are not connected in any way. We also then look to see whether or not there's selective licensing where the property is located. So a lot of councils, particularly London boroughs, have selective licensing. And since April 2020, the additional licensing is now requested when that tenancy is more than one family unit. So when more than one family unit rents, even if it's on one AST, let's say 3 non-related people, it could be Roger, Dan and John. Me and Dan are related, but John's not. But that would make it a HMO, 3 non-related people. So if there's a selective license in place by that local authority, so all the privately owned bike-lets are registered, the moment a tenancy is to be created, then an additional license application is triggered and a change of use needs to occur and planning needs to happen. And you need to check with that local borough whether or not that planning application needs to occur prior to that tenancy agreement being given. So they're the points we need to check out. So you don't need to have the 5 people mandatory license to need planning. It could literally be 3 people. But if you actually get us details across of that property through Crystal, what we'll do is we'll take that to our real estate team and we'll come back with an answer and we'll tell you what extra information we'd need. I hope that answers that question.
No, I mean, from my point of view, that does answer that question. And for me to touch on it, again, that sort of structure, we could do absolutely fine. Now, albeit at 75%, maybe a push, dependent on appetite and I suppose valuers' comments more than anything, but we could definitely do it. It might be down to, say, worst case scenario, 65, 70% LTV. But if it's something that we are keen on doing, again, our relationships with certain lenders like yourself and say Together and a few of these other brilliant specialist lenders, we can refer it and then they can send it to their risk team and their credit team, and then ultimately they can make that decision. So if it's something that doesn't quite fit on their standard product range based on criteria, etc., we can ask to put it in front of credit and see what they say, because a lot of the time they do overturn certain decisions. Some of it might be set in stone and we can't, but again, it's worth asking that question and coming to the likes of us because of our relationship with certain lenders. And I think just coming on to your point that you just mentioned there, in terms of the relevant permissions and license from the council, that is very, very important, because we're seeing a lot of, say, clients at the moment which are coming to us, which they're wanting to raise money on, say, an unencumbered property, which is actually a HMO. We go, yeah, that's fine, and we can do X, Y, Z, get the valuer to go out, but actually it's not classed as a HMO because it doesn't have a relevant license. We've done one recently, which was a huge property. It would have been a fantastic deal, but it was actually supposed to be 4 flats, which the owner has actually converted into a HMO, but hasn't got the license and change of usage. Therefore, no lender's going to lend on that because ultimately he hasn't got the right permissions in place to do so. So again, if you're not asking the question as to, look, do you have a license in place? Have you got change of use or the correct usage in place for this type of property? Then just make sure you are, because I suppose it's not so much duty of care to the client, it's just making them aware, because some people aren't aware and they just think it's perfectly fine to crack on as they are and change the use without telling the relevant authorities. And unfortunately, you're not going to get lending on that sort of property. So we're wasting the client's valuation money, time, and any other financial costs that are involved. So it's just something to be made aware of. If you're not asking the question, if it has that relevant license or usage on, then just make sure that it is in place before any application comes in.
Dan, I think that's a really good point. Tony, before we answer your question, I think Dan's really hit on something. So let me just quantify. And I was in a few conversations with brokers this week where they had applicants who had HMOs and they're wanting to put a 5-bed, they live in a 5-bedroom property. They're moving out and they want to convert that to a HMO. And I've said, have you got planning permission and a license applied for? And the applicant said, you don't need to get a license for a 5-bed HMO. So at that particular point, you know that the applicant is not necessarily the applicant that you would really relish to lend to if they can't understand a 5-bedroom HMO, which potentially could take up to 10 people. As a rough example, depending on the size of the rooms, it's about understanding the capacity. So let me be very clear. If you are ever in doubt, the definition of a HMO, it's when a property is occupied by 3 people comprising of more than one family unit sharing one or more facility. Now, depending on where that property is, you may need to get planning just to create an AST. You may be able to do it under permitted development rights. So there's lots of areas where permitted development rights is still applicable, but a lot have brought in what's called Article 4. So Birmingham, where I am, so if I was to buy a 2-bedroom flat, rent to 3 non-related students, that's a HMO, and I would need to get planning, though I would not need to get a license. However, if I was in one of the boroughs in London where selective license, for example, is in place, I would need a license just because it's a buy-to-let. And I'd also need an additional license because the tenancy was 3 non-related people, and I would need to get change of use to convert that property from residential to HMO. Now, we often see applications come in to Precise and Kent Reliance where a license is in place and it's maybe even been renewed once. So that's more than 5 years. And a remortgage is going through, and right at the last minute, the lawyer asks to see a copy of the planning for change of use, and it's not there. You can go back and challenge retrospective planning because prior to, say, an Article 4 coming into place, that you were able to establish and prove tenancies that the property's always been a HMO, and it's possible the local authority may grant that planning, but it's just as likely that they'll decline the planning and that property's got to be then gone back to residential. And Dan, I know you see a lot of applications where the estate agent has said that the property does not need a license. You were all right to convert, say, a large house in, I don't know, London into, in effect, a large HMO, and it was to increase yield, and you might be able to rent the rooms on Airbnb or whatever the scenario is. And I know you were very good in being able to explain the facts, give the links, and then the customer may have to reconvert the property back to residential because they've never got permission to actually rent that as a large HMO. And we do see that a lot, don't we, Dan?
Yeah, no, we do. And it's just about people's understanding more than anything, in my opinion, and where they're getting that information from. It kind of comes back to what John touched on earlier. There's so many tax advisors out there which are terrible at the job. They really are. And I get so many brokers on a daily basis that I'm mentioning around stamp duty and corporation tax relief, how easy it is to move properties from individual to limited company and not have to pay CGT and all this. And we just know it's wrong. But that's because we have a really good tax advisor that we liaise with, which obviously John is that tax advisor. But again, a lot of estate agents read something online from someone who's not got a validated source as such and think they know everything. It's like when the stamp duty deadline came out and there was literally an article in the Sun of all places that mentioned around the pros and cons of it, and people are reading that as if it was the Bible. It's not. It's just about getting a validated source. I don't know what you're laughing at. Getting a validated source that you can back up your comments really more than anything. And again, a lot of people do feel they understand certain things. However, it's actually about whoever educating them. So I'm not saying I'm an expert in every single field. I'm not, and Rog, you're not, because again, that abbreviation there, we didn't know what it was, so to speak. So it's just about getting truth or a validated opinion more than anything. So
that's so Dan, the question you've just said, let's get John to bring that alive. Do you want to just ask that John that question you just said about how easy it is to move properties from personal to limited, and could he simplify incorporation tax relief in under an hour, John? Come on, because there's a lot on that. So if you can maybe just explain moving from personal to limited, the different ways, and also possibly we do get a lot asked about the beneficial interest has been transferred into a limited company, but the property hasn't been moved. Could you condense that in under an hour?
Under an hour, I'll give it a go. Right, so there's 3 parts to that question. There's stamp duty land tax, there's capital gains tax, and it's what you actually need to transfer. So do you transfer the legal ownership and the beneficial ownership, or do you transfer just the beneficial ownership? Okay. People may be aware, but just to give a bit of background to it, in law, you can split the ownership of an asset. And the kind of the way I describe this is, you go to a shop, you buy a book. There's a transaction whereby you hand over cash, they give you the book back, there's a receipt. At that point, you have legal title to the book. The beneficial ownership is you can then take that book, read it, burn it, stack a table corner on it, throw it out, give it to a library, lend it to whoever you like, okay? And it's the same with property. There is a legal title, which is at the land registry, and the mortgage attaches to the legal title, okay? So when you are taking a mortgage, the mortgage company or any form of lending, they look at the legal title. Tax follows the beneficial ownership. And under tax law, you can transfer the beneficial ownership to another party without affecting the legal title. Okay. So the way you do that is something called a deed of trust. And what you do is you basically, as a property owner, you can transfer a property to a company, for example. You are holding it on trust for the company. It's not a big complicated trust, it's something called a bare trust. And that basically means the company has all the rights and beneficial ownership of that property and all the obligations to pay the debt, but actually the lender is none the wiser because the legal title and the mortgage still sits with the individual. Right. So it can be done from a tax point of view. I'd obviously recommend you check it out with your lawyer and your lender to make sure they are happy with that arrangement. There are a number of people I know who don't, may come unstuck further down the line. Okay, so that's the split of beneficial and legal ownership. You can do it. Okay, now incorporation and corporation relief, as I say, two taxes. Where you transfer property from yourself as an individual to a company, the company is deemed to be a third party. It's separate from you. Okay, if you transfer an interest in land from one party to another, there is a stamp duty land tax cost, right? As an individual to a company you own, that stamp duty land tax cost is based on the market value of the property, right? There is an exclusion to that rule, whereby if you transfer a property from a partnership to a company, and the owners of the company and the owners of the partnership are broadly the same people, in those circumstances, there's a really complicated formula, but basically in those circumstances, stamp duty land tax may not be payable. So there's been a lot of advice about there of, well, basically, let's go and form a partnership, and then 6 months down the line, we'll go and move it into a limited company. That doesn't work, right? And there are two reasons it doesn't work. One, there's a little bit of the law that says, if you do that, and you transfer from the partnership within 3 years, we'll charge you the stamp duty land tax. Secondly, there's another bit, it's called anti-avoidance, and the clue's in the title. If that partnership was put in place purely to avoid the stamp duty land tax charge, the revenue will ignore the partnership and treat it as a transfer from you as an individual to the company. Okay? You need a good and strong commercial reason to transfer properties from a partnership to a company. That can be, you might have better access to finance. That can be, you want a better form of limited liability. That can be that you're looking to separate your interests, but you need a strong commercial reason to move it to a limited company. Okay. The revenue are also pretty slick on what constitutes a partnership. So there is a world of difference between joint ownership. A lot of husband and wives say we're in a partnership. They're quite evidently not, because they've had personal tax returns showing they've had separate property income. A partnership generally requires its own tax return, and a partnership ideally has its own partnership agreement. You can have a partnership without that, but you need a lot of strong evidence to show that you were actually in a partnership, such as its own bank account, such as its own trading name, to show that there was a partnership in place. So that's stamp duty land tax. Now, the other thing,
can I just ask one question, just to quantify? You say the partnership realistically needs to run for 3 years, not for the revenue to question when it was transferred into a limited company about paying stamp duty, yeah? Right,
so not quite. What it is if it's transferred from the partnership to the company within 3 years, the whole planning unwinds automatically under the law. Doesn't matter if the revenue question it, there's a bit of law that says the stamp duty is still due.
So it needs to be 3 years minimum before you do it.
Yeah.
Thank you.
There's absolutely no way around.
No way around that.
Okay. And is that the law that appertains to incorporation tax relief?
Yeah, that incorporation tax relief is around capital gains tax.
Right. But if the stamp duty act of that's
Finance Act 2003.
It's what?
Finance Act 2003.
That'll do. Thanks, John.
No worries, feeling slightly geeky now.
I like a bit of geeky. Go on.
All right. So incorporation relief, right. So a lot of people think incorporation relief is easy. It's kind of, you incorporate your properties into a company and you claim this incorporation relief and it's free from capital gains tax, right? That's just not the case. Okay, so there is a relief called incorporation relief and it does give you a deferral of capital gains tax. It doesn't wipe it out, it defers it, okay? And the way it works is, as I was saying earlier, a company is a third party, right? So if you sell something to a third party, it has to give you something in return, right? In this case, what happens for incorporation relief is you transfer your properties to the company gives you shares, right?
Yep.
The properties go into the company at market value, okay? Because you're the shareholder and you're also the property owner. So it's called a connected party transaction. So regardless of what is paid or what value you think you're putting them in at, the revenue say it goes in at market value for tax purposes, right? So if your properties cost £1 million, they're worth £2 million, there is £1 million capital gain potentially payable, right? Your properties are worth 2 million, so the shares coming out to you are worth 2 million, right? The way incorporation relief works is the revenue goes, right, you've got no cash, and therefore technically you can't pay your capital gain. So what we'll say is, instead of your shares being worth 2 million on a future disposal, we'll take the gain you should have paid now and we'll knock it off the share value. So if you ever sell the shares, the gain you would have paid becomes taxable then, right? The problem with that is a lot of landlords have taken cash out of their property portfolios, okay? So they've got their portfolio and they've borrowed. So let's say we've got the same portfolio. It cost £1 million. It's worth 2 million, but I've got £1.5 million of debt on it, right? So this time I'm transferring in my 2 million of value and my £1.5 million of debt. The shares coming out to me are worth £500,000. Yeah, market value less debt, £500,000. But my capital gain is still £1 million. I can't shelter £1 million and £500,000 worth of value. So £500,000 of that gain is taxable regardless of the incorporation relief. So you really need to watch where you're highly geared on a property portfolio. The final bit about incorporation relief is you need to be running a property business, okay? And a property business means that you are in it to make profit and you manage it as a business rather than holding the properties as a passive investment. So landlords who have management companies running their property portfolio won't qualify for incorporation relief. People who have 1, 2, 3, possibly up to 10 properties, who are not spending a substantial amount of time. The revenue guidance says 20 hours based on the Ramsey case, which I'm sure everybody knows. Doesn't necessarily need to be 20 hours. But if you're not spending a substantial amount of time managing your property portfolio, the revenue will class that as a passive investment. And if you're transferring a passive investment, not a business, incorporation relief doesn't apply. How was that, 10 minutes?
Yeah. Well, I mean, that was good. I mean, I could have said it better myself, but John, and I'm sure we might get some questions on that. Dan, before we go, can we just answer Tony Chewin's question? Because I'm sure we've both got a few questions for John on this, and Ian Clark's come back for one. But can I just go back, just come off John for a second? Let's go back to Tony Chewin's. Tony said, why is it so hard for a lender to lend on properties that will let to asylum seekers? So my response to you on that, Tony, is it's a general market industry. Asylum seekers are classed as vulnerable people, and we've got to understand about their needs and their safety. So if a lender lends on a property that is going to be occupied by vulnerable people, consideration needs to be given. If, unfortunately, the landlord fails to meet their mortgage contractual obligations and a possessory position is then enforced, when it goes to court, that the judge really would give significant leniency to the occupiers and their vulnerability status, and it could take years before possession is given. So the reason that there's so much restriction in the market, even though it's a great business model, and I wouldn't want anyone to consider asylum people as a business, as a product. So let me try and make sure I've got a much emphasis within that, but some people would perceive it as that. I certainly wouldn't. These are vulnerable individuals, and it needs to make sure that they're housed safely and that the effects of a landlord failing to pay the mortgage wouldn't cause harm or distress to these people anyway. So which is why lenders are very reticent to actually enter that category with my response. Dan, have you got a response that way before we go back to John?
Yeah, again, it kind of mirrors what you said there. So anyone or any tenant, owner, whatever, which is potentially a potentially vulnerable customer, whether that's an asylum seeker, it's a care home for the elderly, or for sick children, or a place of worship, or somewhere with community ties. Again, it's kind of reputational risk and what you said there. So ultimately, it's, would you really go for a repossession on that sort of property? How does that make you look as a lender? And it just, I suppose, in a nutshell, that's the reason why anyone who is vulnerable as a client, tenant, what have you, you are going to face them hurdles. Now, there are lenders out there that will do it, but at higher LTVs and I suppose your better rates out there, ultimately, there's not much picking, unfortunately, just given the nature of the client and the fact that they are classed as vulnerable. It's like when you're doing a mortgage application yourself for an elderly client, a lot of the time you do have to go for independent legal advice just to make sure that they're covered, you understand what they're doing, and they're of sound mind, so to speak. So it's just about covering the lender's back more than anything in terms of reputational risk and repossession. And it's just about that physical client in that property, it is my view. But there's possibilities out there. Like you say, it's just there's not too many because of that risk element.
No, that was a really well put other angle to that question, Dan. Glenn Lewis. Glenn is a really great broker friend of mine. Glenn's just put in the comments that John McCaffery is a mind of useful information, and he thought I was good, so I've been downgraded. So Dan, do you want to ask John Ian Clark's question, please?
Yeah, so it's for John and it's for you as well, to be fair, Roger. And I can chip in.
Let's give it to John first, and then I'll come back afterwards, depending on which way John goes. But come on, let's go with John first.
It's the John McCaffery show, guys. We'll be adding on to his next. Right, thank you for your question, Ian. So, John, first part for you. We have an SPV limited company for acquisitions. Should the rental income be received in this company or a separate entity, and how will this affect how the lenders assess the applications when we go to buy the next one? He's had conflicting comments. Obviously, he wants to value your opinion. So fire away, please.
All right. So I've seen these structures before where the rental income is received by a separate limited company. The worst kind of cases I've seen is where the individual keeps the property, but the company there's a company structure put in to receive the rental income. They're awful structures. And the reason is, the rental income comes into a company. If you want to be able to offset the interest and your repair costs and all that good fun stuff, the company needs to own the properties. The company needs to have the properties which has the debt, and you can then offset that debt against your rental income. Otherwise, you've just got a company with a rental stream coming in, and you're paying tax on that rental stream without any relief for any expenses. It also gets very messy in certain circumstances, not quite related to the same situation, whereby you've got the capital in one company, the property itself in one company, the rent in another company. You're trying to offset the improvement costs against the rent, but then you come to sell the property, and the company that holds the property hasn't incurred the improvement costs. So you're paying higher capital gains tax at that point as well. So I would always have everything in one entity.
And from a lender point of view, Dan, what we're not, so as John will deal with the tax side and give his views on that, we're looking at affordability. So when limited companies became popular, and we talk about limited company SPVs, so let's make sure we break down acronyms, so specific purpose vehicles. So since June 2016, when incorporating a limited company now, you've got to give your SIC code, standard industry classification. And there's primarily 3 SIC codes that are universal within the lender world. And we can give you those 3 numbers afterwards. So when we're looking to assess, we as lenders, so I'm talking about industry wide as a generic, lenders will actually look at the income for affordability. So when you think of doing a buy to let, do we assess the individual's income to support the loan? No, we assess the income's affordability and status to cover rental voids, but the ability to repay or to service the interest, let's say in the majority of cases, it's to service the interest. The ICR, the interest coverage ratio, it covers the ability for the rent yield to work at 125, 140, 160 ICR, depending on that lender's ICR rate, to be able to ensure that that buy-to-let can not only meet its monthly interest payment, it can, in personal names, it would meet the increased tax burden, which is why a limited company has the lowest ICR calculation. So if we get an application in of 3 buy-to-lets in a limited company, and that is the legal ownership, but when we look at the bank statements to see the rental income and the mortgage payments coming in and going out, they're not there. There's actually nothing that's been transferred to another limited company. Then it would fail to meet the lender's ability on affordability and assessment. That's standard throughout the industry. And I don't know any lender that being able to verify the information would be able to facilitate that, Dan. So from the OSB group, that would be a flat no. And then listening to what John says, without me giving any advice or opinion on what John says, it would be a negative situation. Have you got anything to add that would maybe summarize the 3 points, 2 points?
No, not to be honest. I think you bang on with that. And obviously, as you've mentioned there, lenders don't like it and won't like it, so to speak. So I think don't try and overcomplicate it and find a loophole, because ultimately there isn't one in this sort of scenario. Which I know obviously a lot of people look for loopholes, whether they're moving from individual to limited company. We've all heard about how you can move to an LLP and then a limited company, and ultimately you don't pay the CGT or stamp duty. But we're not as clever as HMRC, as much as we'd like to think we are. There's rules. Well, I can't. I'm just saying that because in case they're watching. But yeah, so there's ways of wrapping it up, as John's mentioned. But no, from a lender point of view, and I suppose our point of view, you bang on with what you said there, Rog. Another tax questioning from an anonymous attendee. John, will the IR35 changes mean more paperwork per application?
Right. I don't know if it'll mean more paperwork for application, because I don't understand how it would impact. But if I tell you what it means, and then maybe you can comment on that. So IR35 is where you have a consultant who operates through a company, their own personal company, charges a third party for their income, and the revenue look at that arrangement and go, well, if the company wasn't there, they would probably be deemed to be an employee, right? The reason they use a company is they can charge it, they'll pay tax at corporation tax rates, and then they will probably split the income between either them and their spouse, and they'll pay it out in dividends, which means there's a national insurance saving, and overall there's a lower income tax because 2 people earning 50 grand pay a lot less tax than 1 person earning 100 grand. Okay. The other possible part is I know a lot of these consultants charge from their company, don't take all the money out, and then use the funds they've raised at corporation tax rates at 19%, and then they invest in property. Okay. Now, the IR35 changes coming in what's happening is that the end user of their services, so the client, whoever's hiring them ultimately, will now decide whether actually they're employees or not, or should be taxed as employees. There's a difference between taxed as employees and being an employee, right? And if they do decide, they will be subject to PAYE and national insurance on that payment. So their net income will be substantially lower. I don't know if that will impact on the application process.
Yeah, absolutely will be, John. I mean, this comes into effect from the 6th of April this year. And it's just, there's been, most of the big businesses that I know have looked at this, where previously people have been self-employed, working wholly for the benefit of that company, and they've had to change. And an awful lot of mortgages businesses out there where they've got mortgage advisors working, being supplied the leads in the office, using heating and lighting, being classed as self-employed. They've had to completely rethink the business model. So I think, again, there's an awful lot of information on the web on this, and I think it's about understanding that particular change and transformation. And there's an awful lot of information on lenders' different websites. So I think that answers that question. Dan, let me answer this question, because this has come directly from you. Good morning, Marie. Dan, which lenders do you use for semi-commercial property, cafes downstairs, and flats or HMO in the same building, commercial and resi, and they've got separate entrances? Now I'm just stretching for a second, Marie. But I'll let Dan answer the question. But don't know why I'm stretching. But anyway,
okay? You need to stand up and do some long stretches. Do you know what? Brilliant question, Marie. And the fact that now Roger is doing this webinar from InterBay, and InterBay have got some absolutely market-leading semi-commercial propositions at the moment that, like you said, the rates are fantastic, and the start with a 4 ultimately. I'd say InterBay, to be honest. We use them. We use the likes of Shawbrook Bank. Again, they've got some really good products. But in terms of market leading for that product, as you've mentioned there, that property type, that client, it'd be InterBay. So, Roger, do you want to touch on that product? It's been teed up perfectly for you there.
Well, I'm really interested in the perception of really how InterBay seems to have captured the imagination. And there's our standard range, but I do believe we've got some semi-exclusive, semi-commercial products where the minimum loan isn't 150,000, it's £100,000. And I believe that semi-exclusive is available, first of all, through Crystal Specialist Finance. Is that right, Dan?
That is right, Roger. Yeah,
brilliant.
No,
So you've heard that live here. So kind of understanding InterBay commercial and where it fits. It really fits with your larger HMOs. So when you've got a HMO and it's above 10 bedrooms, it's normally in an Article 4 area. So it's got protected status. What that means is it stops other investors coming in and setting up HMOs. So Article 4 actually gives you that protective status. Next, normally those landlords run that as an investment. So they want an investment valuation, commonly known as a long form valuation, the ability to assess the property, not on its bricks and mortar, but its actual yield, the income that it can give. And you can find out more information from Crystal's specialist help desk on how that works. So when it comes to those large HMOs and multi-unit properties, or even if it's a HMOs upstairs and downstairs could be multi-units, or in the situation that Marie had put is where you've got on the ground floor a coffee shop. Now, if those coffee shops are specifically not in big city centres like Birmingham or London, but in our peripheral smaller towns and on the outskirts of larger cities, those coffee shops have most likely sustained their business model well during COVID-19 by doing carry out and takeaway coffees, foods and snacks. So actually, as a business that's had to shut down during COVID-19 on that example would be a great one. So thank you for using that. And then upstairs could be a mixture. It could be individual flats rented out. And again, saying it's on a separate entrance is excellent. Or there could be multi-units, or it could be a HMO, or a mixture of everything. Because remember, a 2-bedroom flat could be a HMO, and then next to it, that 2-bedroom flat is just rented to one family, or it could be those multi-units. In situations like this, these are the sort of products and properties that InterBay would love to do on that semi-commercial basis. And we can go to 70% loan to value, and you'll be able to get those exclusive or semi-exclusive deals through Crystal Specialist Finance. And when it comes to commercial marine, if you're looking at those sort of factories, we're looking at those sort of warehouses that are relatively, there's no fixed commercial production. So if you've got like a big production line inside a factory with lots of equipment, lots of fixed machinery, that's not the kind of commercial property we're looking for. It's more empty warehouses or warehouses like similar to a small version of an Amazon, which relatively don't have fixed equipment, and that if the current tenant had to leave, they would be emptied out quickly. But again, the commercial desk at Crystal will be able to help you on that. But I really think that brand, the whole InterBay brand's done really well, Dan, hasn't it? And I know you guys seem to be flying with us at the moment.
Yeah, no, yeah, there's been so much hype about that product, and it really is a fantastic product. That's all I can say on the matter, really. I mean, in terms of the other lenders getting their share of the deals that are coming in that fit that model, again, if there's any lenders watching this, unfortunately not, because you do have a market-leading product, and it is there, and you know, it's really good. And more than anything, the deals that you're saying you're doing, you do actually do, which, again, within this marketplace, there's a lot of lenders that will say they'll do certain deals. It gets the valuation or close to completion. They pick up on a lot of things and say, right, we're not doing it now because of X, Y, Z, which is just unacceptable. But again, you'll actually lend. And obviously you've got a good proposition in terms of how many units you'll lend up to, your square footage and all that sort of stuff. So really good. And you pay a decent box. So happy days. It's all around it's all around good. Like you say, I know we've got a lot of momentum on that semi-exclusive range. We don't know how long it's going to last for as such. So if people do have these sorts of deals where it is semi-commercial, please do send them to us. Do you, just quickly on that, because another question, is there any restrictions on the actual premises that's down before from the commercial element? So anything that you do not like, so whether it could be a Chinese takeaway, a laundrette.
I think what we've got to look is the viability of the business on the ground floor and the viability and income on the businesses above. So sometimes you can get a small percentage of commercial offering on the ground floor. And if that commercial isn't viable, let's say in more outward town areas, Dan, you could use permitted development rights and convert that back to residential. So option one, your strategy could be, let's see if we can rent it out in the next 6 months, or we'll have the option to convert it to residential, particularly if either side is residential anyway. So sometimes it's maybe those 3-story Victorian terraces, it's a shop downstairs and it's flats above. For that to convert back to residential within that street makes absolute sense. It's when you look at the commercial bits that lenders really don't like is your obvious Debenhams and your very large, big retail premises, or these big, massive commercial office spaces, which if one office was shut down because of COVID-19, it affects the others. So each case, when you get the details, bring them in and make you understand what those options are. And another point I think that Marie, great questions that Marie had asked was, and it's just more of a question to me to you, Dan, just imagine I work with Marie and I get an inquiry on a semi-commercial that comes in today, and I've never done one before. And there's lots of brokers out there speak to me all the time. Roger, I'm coming across semi-commercial a lot now, but I'm busy. I've never done one before. Is it complicated? And if I don't want to let it take over my life, could Crystal help me with that?
Yeah, I mean, there's two views and two opinions on that ultimately. So it depends on how much you as a broker want to learn, because I'm getting so many people now more than ever that want to learn about these sorts of cases because the market's becoming more diverse. Clients are becoming more diverse in terms of their wants and needs. And rather than just doing the residential and even kicking away the protection and any commercial needs and whatever that may be, people want to actually learn about certain transactions and understand the mechanics behind it ultimately. So we've got two options. So for the broker that is busy, doesn't want to get involved in this sort of case and is happy with their bread and butter deals, they can just refer a case to us. So as long as it's not a regulated case, they can send me or my guys in the office an email saying, right, Dan, I've got Mr. Smith, he owns a semi-commercial property, which is not owner occupied, it's fully investment. It's worth £500,000. He wants to raise 250 against it because it's unencumbered. Can you guys contact him? We absolutely can. We can contact him. We can deal with it from inquiry right the way through to completion. So the broker has absolutely no involvement in the case at all. Once it completes, we let them know and we pay them. Absolutely fine. And we pay them exactly the same as what they would have got if they'd been involved throughout the full transaction.
Wow.
So for a lot of people, that's fantastic because you've got two sets of income, you've got two sets of cases ongoing, and it's the stuff that you are absolutely not interested in at all. It's the stuff you would have passed the Bob down the street and he'd have bought you a pint in the pub when they were open. But we can do that on a referral basis. Now, the other side of things, where again, a lot more people are turning to, is the package route. So we can guide you in whatever direction you need to be guided in. We can educate you around the process, what we need to know, what documents we need, and essentially what will make or break this sort of deal and educate you. So do you know what? You're going to learn more, and then you may not so much not have to use a package, because again, we do get the exclusive and the semi-exclusives as we've just touched on, but we can hold your hand through the process and actually teach you a really interesting part of business. And again, specialist finance, I can't put it any other way. You're going to earn a hell of a lot more than you are dealing with your residential and your vanilla buy-to-lets. There's no ifs or buts about that. If you look at an average profit from the high street, you might get anywhere between 0.4 and say 0.8% on your deals, which it's all right. But if you come over at the dark side, you'd be looking at anywhere up to 2.25% on a deal of the same value with essentially the same working. You're just asking different questions, sending different paperwork, and I suppose acting as if you know a little bit more about what your understanding of the market is ultimately. And again, if you want to earn but you don't want to learn, just refer it. Or if you do want to learn, then you can do it on the package route. We're all about education, but we're also all about making brokers and advisors' lives simple. And that's what it's about. So we work however you want to work. I mean, for me, if you're earning the same money, do you want to learn anymore? It's down to you. It's if you want to broaden your knowledge or just have an easy life and pass stuff off and go and jet off to a beach somewhere, so to speak. So yeah.
Dan, that answers that question. Just conscious of time, we've got two questions to answer because we did say we'd only take an hour. Steve, just come back to your point on what a lender's viewed on service accommodation on buy-to-lets. Now, service accommodation can be quite a wide range. Now, I remember being involved in where you, in effect, bought a hotel room. So you'd have a block that was put up and it's built, and you would, in effect, own one of those hotel rooms. And that block was then rented off to one of the big national chains. And some would class that within that serviced accommodation. The other concept would be Airbnb / holiday lets. So it's where somebody has the ability to rent a cottage for 3-4 days or a week, and then it's serviced either daily or at the end of the stay. So when it comes to holiday lets and the increase desire by lenders with the expected increase in vacations is something that you want to really become informed on, because I do believe that is a great area. And I actually think this is something to think about. When it comes to Airbnbs, a lot of lenders don't like that. We saw a recent move on Barclays accepting that their properties will be rented out on Airbnb. And they were the first large lender to really accept that. But what I would say is it just depends specifically how that works. And then, Dan, you've got a question that came in anonymous. Do you want to read that one out?
Yeah. Do you lend on semi-commercial properties in local towns where clients want to live above and carry out a business below, such as a coffee shop? Commercial element is over 60% in total. So does that mean it's unregulated overall and acceptable? What's your views on it before I give my views?
So we'll look at that. When we look at semi-commercial, it depends on what you define as regulated. So we would look at semi-commercial and buy to let. So rented out upstairs, and downstairs was commercial. We class that as semi-commercial anyway. So we'd be happy to do that. And again, it just looks at what that business is and that business accounts and sustainability. Where you've got a commercial at 60%, the actual accounts and actual cash in the bank over the last 12 months becomes absolutely imperative, because You can't rely on the rental yield. Say it was at 75% residential because you got buy-to-lets upstairs. You could actually put a business case that in effect that's going to be able to service your monthly interest with a bit of consideration for the commercial downstairs. But where the commercial is 60%, then you've really got to give a solid set of accounts and bank statements more than the accounts to prove the liquidity and affordability and serviceability of that particular mortgage would be my answer on that one, Dan.
Yeah, no, I'm banging with that answer. So in a nutshell, yes, we've got options available. In terms of what sort of LTV you're probably looking at, because there's, dependent on experience, bank statements, trading history, especially over the past 12 months in terms of what sector you're in currently. So obviously if it's a, say, a news agent, then you're going to be in a far better position than a clothes shop, because obviously that's essential and that's not essential, so to speak. But it's something that can be done. It's just about understanding the deal, understanding the figures, the financials, experience, history, all that. And then that combined defines what sort of LTV you can get. Now, on that, you're probably going to be looking at max, I'd say 70% LTV, but realistically, you're going to be sitting more like 60, 65%, in my opinion. Again, I'm not an underwriter, so I can't give you a definite, don't hold me to that, but I'd say you're going to be more closer to the 65% LTV mark, and potentially you may be in the higher interest rate mark, but that's just a guesstimate from me. Again, if it's a sort of deal you've got in, please do send it to me. I can have my underwriters review it, and then ultimately come back to you the best possible terms. So, but thank you very much for that question. And I think, looking at the time, that is an hour. So unless there's any more quick questions that want to come in, I think we will wrap it up and stop taking pictures of us, Roger.
I capture that today. Yeah, I think we're at the end of the time, John. Dan, John, have you got any words of wisdom you want to finish off before Dan closes off? And thanks, everybody.
Serviced accommodation, very, very quickly. Right.
Here he goes.
Here we go.
Let's forget about John's always got an answer. I haven't thought. Go on, John.
Right. Serviced accommodation has a very, very different tax regime. Okay. So if you are doing serviced accommodation, your income is split between services provided and rental income. Right. A lot of people in that industry kind of forget this. I'm going to try and keep this brief. Basically, income from services is subject to national insurance, whereas rental income isn't. If the income from your services is sufficient to take it above 85 grand, you've got to register for VAT. And you've got to charge VAT on those services, which a lot of people aren't. And the final thing, which I'm sure everybody was aware of, if you are, so two more things, sorry. The furnished holiday let, if you have a furnished holiday let, it's available 240 days a year, and you actually rent it out for 120 days a year. That's deemed to be a trade, and you can claim tax relief on your assets within your furnished holiday let under a capital allowances regime. The final thing about services is if your services are sufficient in terms of your overall property portfolio, you may be able to argue that actually the property portfolio isn't subject to inheritance tax if it's, say, within a company or a business. They have to be in value and producing more than, say, 50% of your overall income. And it's very touch and go. There's a lot of cases on it. But service accommodation, really, really, you should be taking some pretty detailed tax advice.
John, am I just right that if I had a holiday let and had it for 10 years, and it's gone up by, say, 500 grand and I sell it, am I right in thinking you can get entrepreneurs relief and only pay 10% capital gains?
Correct.
Wow. So subject to the chance not changing that one. That always sticks in my mind as a great one to do Dan out of his inheritance. Dan, I'm just so grateful for the amount of questions. There's too many people to shout out to say thank you for the time taken with those questions. And really, I just think it's incredible that you've taken the time, you've given us an hour, the numbers have remained, so we need to close off now. And just, if you got, we're going to do this again in a month's time. Yes, Marie, love you and thank you so much. If you've got any questions for next time that you want us to go into, Dave will get out the email for the next one and we can cover off any of the subjects that you want. And also, thanks, Machine. You've just come back on there. Thank you so much for the kind words. And Dan, I'll let you close us off and wish everyone a good morning. Go on, Dan.
You just stole my thunder there because you pretty much closed it off. But yeah, No,
Thanks,
again,
Ian.
thank you very much for your questions. Like I said, there was no agenda, no script, nothing. It is what you make it, and there's been lots of fantastic questions. Massive shout out, as always, to John, who just comes up with these absolute curveballs and brilliant answers. So please, honestly, if you do have a tax advisor, make sure he's as good as John. If not, link up with him. He's a great guy, as you've seen. He knows his stuff. And he's fantastic. His contact details will be sent out after today with your CPD certificate. Obviously, a lot of you will have mine and most of you will have Roger's, but again, ours will be in that email. Please come up the next one in a month's time. Think of some questions, think of some stuff to get us stuck, because we're always looking to learn and earn. But more than anything, thank you very much for the last hour, and hopefully you found it useful. So on that note, gentlemen, it's been an absolute pleasure. I'll catch up with you all soon. Everybody else, have a fantastic day, and give me a call or drop me an email if you need anything. Have a good day, great day, guys. Speak soon.
Take care, guys.
Bye.